For the last 80 years, the American economy has been running on a quiet, almost invisible financial arrangement. Whenever the United States government needed to borrow money, the rest of the world lined up to lend it. Foreign nations eagerly and reliably bought up American debt by the trillions. They didn't do this as a favor. Countries selling goods around the world ended up holding massive amounts of US dollars. Because the American Treasury bond was considered the safest asset on the planet, it became the default place for those foreign governments to park their cash. This diagram shows the loop that made it all work. Money from global trade flows into US dollars, and those dollars funnel straight into US Treasuries. These foreign buyers were price insensitive. They bought the debt automatically, without haggling or demanding high interest rates, simply because they needed a place to hold dollars. That endless automatic lending gave the United States an exorbitant privilege. It acted like a financial cheat code, allowing the government to run massive deficits, borrow enormous sums, and keep interest rates artificially low for everyday Americans year after year. But right now, that 80-year arrangement is unwinding. Those same foreign buyers who reliably absorbed American debt are quietly stepping back from the market. Look at this chart of the 30-year Treasury yield, which measures the interest rate the government pays to borrow money over 3 decades. After a long plateau of remarkably low rates, we see this sudden upward break, pushing yields to their highest levels in years, hovering around 5%. This creates a direct mathematical problem. The U.S. national debt is expanding by roughly $2 trillion every single year. The government's need to borrow is accelerating at the exact moment its traditional lenders are walking away. If the rest of the world is no longer willing to finance American borrowing on the cheap, someone else has to fill a $1 trillion hole. In February of 2022, the 80-year arrangement reached a sudden breaking point. Following the invasion of Ukraine, the United States and its allies froze roughly $300 billion of Russia's central bank reserves overnight, slamming shut the door on an entire nation's sovereign wealth. Every finance minister on Earth took note. It proved that holding American dollars and bonds came with strings attached. Those assets are only unconditionally safe as long as a country remains in Washington's good graces. In response, nations began a quiet calculation to protect themselves. They started deliberately winding down their reliance on American debt, looking for an asset that sits in their own vaults, something no foreign government can freeze or control. This comparative chart illustrates a historic rotation. For the first time since the Second World War, the world's central banks now hold more of their reserves in gold than they do in US Treasuries. They hold 27% in gold, compared to just 22%. The entity stepping in to buy the debt is the American domestic market. It's US banks, money market funds, and increasingly, the household savings of everyday citizens. To understand why this matters, you have to look at how these two buyers behave. The old foreign central banks were captive buyers. They accepted whatever low interest rate the Treasury offered because they had to hold dollars anyway. This split screen shows the difference. On the left, the foreign buyer automatically takes the low-yield bond. But on the right, the new American buyer operates as a traditional investor. They have choices, like putting their money in the stock market. If the government offers a low interest rate, they reject the low yield. Because domestic buyers demand a fair return for their risk, the arithmetic of the bond market changes. To convince an American bank or household to lend it money, the U.S. government has to drastically raise the interest rates it offers on its bonds. Swapping an automatic, uncomplaining foreign buyer for a demanding domestic investor strips away that long-held exorbitant privilege. The entire mathematical foundation of the United States economy has to readjust. Here is a scale comparison of what those higher rates do to the federal budget. The U.S. government is now spending over $1 trillion a year just to pay the interest on its debt, towering over the entire national military budget. But this doesn't stay a federal problem. The rate the government pays to fund itself, specifically that 30-year Treasury yield, acts as the baseline floor for all domestic borrowing. That means the rising yield reaches directly into your wallet. It dictates the price of every long-term mortgage, auto loan, and line of credit in the country. When the government has to pay more to borrow, you have to pay more to borrow. The departure of the foreign buyer is a relentless force driving up the cost of life for everyday citizens, adding a massive burden that future generations will eventually have to carry. To understand where this is heading, we can look at the 1980s. Back then, Japanese investment was flooding into the U.S., buying up treasury bonds and real estate. Many Americans feared Japan was going to permanently own the country, but that financial flow eventually reversed, and the American economy didn't collapse. Moving to domestically funded debt is not an automatic catastrophe. Japan, in fact, has funded its own borrowing from its citizens' savings for decades. But the shift does mathematically ensure a structural move towards higher baseline interest rates and a steadily weaker dollar over time. Look closely at your own savings. Ask yourself how many of your investments, your retirement goals, or your business plans rely invisibly on the outdated assumption that interest rates will stay near zero forever. The quiet machinery that effortlessly financed the American century has started running in reverse. The most dangerous position you can take right now is assuming the financial rules you grew up with are a permanent feature of the universe.